This week, the UK housing market revealed something unusual, something deeper than a typical weekly update. It revealed a market that is no longer driven by a single nationwide trend, but by a complex blend of regional shifts, affordability transitions, structural issues, and socio-economic divides. For years, we've talked about the UK housing market as if it were one massive organism, rising, falling, heating, cooling. But this week's data from Halifax, the new forecast from Hamptons, a major expansion in build-to-rent development, and an alarming report on social housing access show us something else entirely. They show us a country moving in multiple directions at once: a stabilizing buyer market, a recalibrating rental market, a stagnating London, a strengthening Northwest, a booming Northern Ireland, a luxury market regaining confidence, and beneath it all, millions still struggling for the most basic form of housing security. In today's deep dive, we're going to break down all the major developments from this week, but we're not stopping there. We're going far deeper, unpacking what these signals mean, why they're happening now, how they connect, and the real implications they have for 2026 and beyond. So get ready. This is the fullest, most comprehensive breakdown you'll find on This Week in UK Housing. Let's dive in. Let's start with the latest Halifax data, because while a headline that says house prices flat sounds simple, the underlying picture is far more complex. Average UK house price barely moved this month. We're talking about a shift so small, it's statistically close to zero. At first glance, you might think, okay, nothing's happening. But in reality, everything is happening within that flat number. It means buyers and sellers are finally aligned enough that prices aren't swinging unpredictably. It means demand is present but cautious. People are buying, but not frantically. It means lenders are confident enough to maintain stable mortgage products. It means incomes and financing costs have reached an equilibrium point. It means sellers have stopped anchoring their expectations to the 2021 boom. And perhaps most importantly, flat prices after turbulence are a sign of a market that's reorganizing. Halifax reported something many thought impossible in 2025. First-time buyers are in their strongest position in a decade. Over the last 18 months, wages have grown faster than house prices in many sectors, especially tech, logistics, finance, healthcare, and engineering. This hasn't happened at scale since the early 2000s. While rates are still high historically, they're significantly lower than the panic peaks. More importantly, lenders are competing again. Unlike the 2021 frenzy, buyers aren't bidding £50,000 over asking. They're negotiating. They're walking away. They're not panicking. In many regions, sellers who tried to list at 2022 peak prices had to reduce, sometimes twice. The perfect storm, not of chaos, but of balance. Markets don't sit still. They balance, then they break into direction, up or down. And right now, something beneath the surface is shifting. Regions are beginning to diverge dramatically. And this divergence is the story that changes everything. Now, we get to the most surprising news of the week, and possibly the whole year. Why Hamptons' prediction is such a big deal. Hamptons released a long-term analysis suggesting that by next year, regions like the Midlands and the Northwest may outperform London in cumulative house price growth since 2010. Put it simply, London, the titan of UK property for decades, may lose its crown. Why London is slowing so dramatically. Affordability ceiling has been reached. London buyers can't stretch further. Even high-income earners face affordability limits. B. Remote work destroyed London's monopoly. People no longer must live there for career opportunities. C. High mortgage rates have an outsized effect. In London, even a 1% mortgage increase can add £500 to £900 per month to payments. D. International investment slowed. Global uncertainty plus tax changes made prime London less attractive. E. Political instability. Investors paused purchases waiting for taxation clarity, only recently resolved. Why the Midlands is rising. A. Big city alternatives. Birmingham is positioning itself as a cheaper, younger, vibrant alternative to London. B. Infrastructure investment. Even partial HS2 still boosts future value. C. Job market resilience, manufacturing, professional services, logistics, and engineering hubs growing. And why the Northwest is the star performer. If London is the past, the Northwest is the future. Reasons. Manchester's tech and media scene is exploding. Salford Quays has become a growth engine. Liverpool regeneration and affordability are attracting young professionals. Property yields are 2 to 4 times higher than London. Universities bring population stability. New build growth is highly concentrated and well managed. The Northern Ireland anomaly. Northern Ireland deserves its own chapter in this story. Over the past year, house price inflation has reached nearly 9%. Affordability remains among the strongest in the UK. The region is attracting return migration. Investment costs are low relative to income. In a market dominated by affordability issues, Northern Ireland stands out as a place where housing still aligns with earning. What this regional divergence means: the UK is no longer one property market, it's a collection of micro-markets. Implications: investors will increasingly look north. First-time buyers will avoid London. London will lose some of its historical premium appeal. Policy will need to adapt to uneven growth. Businesses may relocate for affordability reasons. This week brought confirmation of multiple new build-to-rent developments across the country. And while that doesn't always make front-page news, it should. Why BTR matters so much right now? Rental demand is at historic highs. Record numbers of adults under 35 are renting. Family renting is on the rise. Landlords continue exiting due to tax pressures. BTR fills the gap left by landlords leaving the market. Institutional investors, insurance companies, pension funds, want stable, long-term returns, and renting provides exactly that. BTR is reshaping how renting is experienced. Higher quality amenities, professional management, predictable maintenance, community-focused design. It's the closest thing the UK has ever had to American-style rental communities. Good, the bad, and the controversial. Good, adds supply fast, reduces pressure in rental hotspots, modern, safe, well-managed units. Works well for young professionals. Bad, often expensive, can gentrify neighborhoods, prioritizes wealthy renters, not accessible for low-income tenants. Controversial. Does BTR worsen inequality? Does it push out traditional landlords? Does it accelerate the decline of ownership culture? These are the questions no politician wants to answer, but renters are living with the consequences. Long-term impact. If current trends continue, renting becomes the dominant tenure for younger generations. Home ownership becomes more class-based. Landlords become institutional rather than individual. Cities become vertical communities dominated by BTR blocks. We're already seeing this in Manchester, Birmingham, Leeds, and parts of London. And it's only the beginning. We can't talk about the UK housing market without confronting the part of the system that's failing most deeply. Crisis New Report, a devastating revelation. Report shows thousands of low-income applicants are being rejected by housing associations. People on benefits are often seen as too risky. Councils are overwhelmed. Children are growing up in temporary accommodation for years. Social housing supply is at a historic low. How we got here: A, right to buy depleted stock faster than councils could replace it. Millions of homes sold, few rebuilt. B, population growth outpaced housing construction, particularly in cities. C, council budgets collapsed. Austerity plus inflation equals fewer new homes. D, private rents soared, pushing vulnerable households into financial stress. E, benefit caps didn't keep up with market rents. Housing benefit universal credit cannot meet private rental costs. Human cost: families living in single rooms, people staying in hostels for months or years, children traveling 2 hours to reach their original schools, rising homelessness, mental health collapse, increasing pressure on social services. When we talk about the UK housing market stabilizing, this is the part stabilization doesn't touch.